When I am investing in the stock market, I am trying to find businesses which have a very high return on equity, because what is return on equity? Return on equity is basically the money that I am getting as opposed to the money that I am putting into the business. That's return on equity basically. So higher the return on equity, the better is the company. However, there are 4 points that I want to discuss about return on equity, because return on equity sometimes can be misleading. Point number 1 is high debt. If the company has high debt on the balance sheet, if the company is over leveraged, so you have very small equity but very high debt. So that is the capital that the company will invest in the business and make a lot of profit from that, because a lot of capital is being pumped into the business. Now that large profit, if we put it in the numerator and in the denominator we have a small equity, that will show a high return on equity, which is artificial. That return is not coming because of the equity. That return is coming because the company is leveraged. So just because the company has got high return on equity does not mean that it's a great company. The company has actually raised money by selling bonds, and the company has to eventually repay back those bonds. So a high return on equity company but having a lot of leverage on the balance sheet, I don't like such a company. I want companies where the return on equity is high and there is no leverage on the balance sheet, little or no debt. That is point number 1, high debt. Point number 2 is high cash. Sometimes what happens is you will find a company like Colgate, Castrol, Nestle, VST Industries. They have a lot of cash on their balance sheet. They have little or no debt. They have high return on equity. But if you observe the trend of the return on equity over a period of 10 years, you will find that the return on equity is falling. Now, why does this happen? This happens because cash keeps piling up. Even if they give dividends, there is still a lot of money left on the balance sheet of the company, and that cash pile keeps increasing, which keeps increasing the equity, and the denominator of the return on equity ratio increases and the profit does not increase as much. So the return on equity over a period of time keeps decreasing. Now, just because the return on equity is decreasing over a period of time doesn't mean that it's a bad company. The names that I took just now, these are good companies. Some of these are great companies. But they generate so much cash flow, and even in spite of giving away dividends, cash keeps piling up in these companies' balance sheet, which expands the equity. So don't get fooled by the decreasing trend of return on equity. That doesn't mean that it's a bad company. Number 3, low retained earnings. Now, some companies have such great earning power that they don't need to retain any earnings. I think I was looking at the balance sheet of Colgate, and they have given away, I think, 97% of what they have earned over the past 10 years. I think they have given away 97% of their free cash flow in the form of dividends. So basically, the company doesn't want to retain any money because the earning power of the company is such that you don't need that money. You just give it away as dividends to the shareholders, keep the shareholders happy. So with that, what happens is, since there is no retained earnings, the equity remains small and the profit is ticking along because it has got great earning power. So that again gives you a high return on equity company, because the company is not retaining any money. So you have to look out for such companies where the equity is deliberately kept low, high dividend company, and the return on equity always remains very high. In some cases, the return on equity remains more than 100%. But anyway, that's a great business. But you have to look at return on equity in multiple different ways, because it's not a static ratio. You have to look at the ratio, then you have to look at the ratio for the same company over a period of 10 years. Then you have to look at the ratio of different companies in the same sector. That will give you a better idea of which company is the best in the sector. Number 4, book value, which is the equity, which is the denominator of return on equity. Book value may not be an accurate representation of the real value of equity. When I say book value, I'm talking about equity total, equity capital plus retained earnings. Why? Because sometimes the assets are not uh, shown on the balance sheet at their fair value. Let's say a company had bought some land maybe 5 decades ago. Now that land is not shown at its current value. It has been 50 years. Now the land has appreciated in value. That doesn't get reflected on the balance sheet. Similarly, intangibles. Some companies have such great brand equity. The brand has got a lot of value. That brand value does not show up on the balance sheet. So the equity that we see, the denominator of the return on equity, is understated. Actually, the equity is much larger than what we see on the balance sheet. So if the equity is understated, that means the return on equity will be overstated, right? So these are the 4 points that we need to look at when we look at the return on equity of a company. So first is high debt, second is high cash, third is low retained earnings, and fourth is the book value may not be the fair value. So carefully observe the return on equity and figure out why return on equity shows a particular trend for a particular company, keeping these 4 points in mind. Thank you so much.